Good morning, everyone. Brooke Chanfiki here from Legacy, also known as Big Sis Finance across socials. I hope you're having a fabulous morning. Today, we're going to talk about personal financial statements. Ooh, and I'm going to give you the New York style convo, right? I'm going to work into this conversation about personal financial statements, also known as balance sheets, personal balance sheets in some circles. They're interchangeable. I'm going to work into this conversation the New Yorker view. And I hope that what it's going to do is it's going to give you a little zing, a little aha moment of, oh, that's why we want to have certain assets on our balance sheet. That is what they do on our balance sheet. That's why diversifying different asset types is so powerful when you're building your wealth. Now I get it because I can see it on your glorious and incredibly simple balance sheet, Brooke. Thank you. Thank you. Yes, I work hard to make things super easy, to teach well, and to really impart you with the life wisdom that you need as you're moving toward financial well-being. So consider this a freebie. I'm dropping it in the well of helping the universe. And if you like it, please like, comment, subscribe. If you don't like it, because some people don't like my videos, I still love you. I wish you well. And to all the haters out there that feel the deep need to tell other people about the things they don't like, I hope that the pain inside of you heals over a period of time. Anyway, without further ado, siblings, we're about to go on the personal financial statement journey. I am going to walk you through an Excel spreadsheet, but don't worry, it will not be boring. I can't live a boring life. We must live with zestiness. So this personal financial statement conversation is going to be me jumping around a very simplified personal financial statement and showing you the 3 things that you need to take away from your own personal financial statement. No shame. Be grateful for what you have. Do not ever beat yourself up about where you are today. You are on a path. You are on a path. You are working toward something. So never stop and say, oh, this is terrible right now. No. You're on a path. You'll be fine. It's all going to be fine. It's going to work out. So let's pop over to my Loom so that I can walk you through a really gorgeous New York spicy balance sheet. See you shortly. Hello again. Welcome to a personal financial statement, the New York spun way by yours truly, Big Sis Finance. Let me move my head because it's like right in the middle. Okay. Now, I have put together a sample personal financial statement. I am starting on the asset side of the balance sheet, not the liabilities and net worth side. I am going to talk about, using fake numbers as examples, 6 types of assets, big bucket types. If you're incredibly wealthy with lots of business interests and lots of different types of investment accounts and different homes and different properties, you're going to have these in the expansion pack version. You're going to have lots of detail underneath each of these individual items that you see here. You'll have tons of different details. However, this is a collapsed and basic version. I'm going to make 3 points as we go through this, beginning with point 1. Income producing assets rock. Log that in. Income producing assets are your best friend. Income producing assets are the bee's knees. They're the best thing to happen to a personal financial statement. And so what I've done differently than typical personal financial statements is I've collapsed into this personal financial statement the income, and you'll see the expenses generated by these actual financial assets, right? So you have these assets. They are your assets, and they can generate income, which rocks. The typical income you see generated on most individuals' personal financial statements are income from cash or income from investment accounts. Investment accounts and cash accounts can take so many different flavors. You have retirement accounts, and you have your brokerage accounts, and you have your trust accounts, and you have all these different accounts. But okay, that's cool. Think of cash as like the most easy to access, but also is going to give you very little income. And think of your investment accounts as everything else that you can get access to relatively easily with a market that's ready-made, meaning there's someone who's willing to buy that asset from you really, really quickly, 30 days or less. Not a longer-term asset, which would take a time to identify a buyer, and maybe the market for that isn't as liquid as the liquid assets. It takes time to set up a transaction where you're attempting to sell your primary home or sell a business interest or sell a rental property. So my liquid assets here, this is where you see as people are starting their investment journey, their getting wealthy journey. Most begin by thinking about how do I get some financial assets like stocks and bonds and, fund my 401k, checking and savings accounts. How do I do that? That's kind of where you start. And then the stuff that's down here in the longer term assets, your primary home and car, again, big bucket items, primary home and car, which are the things that you use personally to be able to live in and drive back and forth to work. That's your sort of starter package, which don't create any income for you. Note, they don't create any income for you. And then your business interests and rental properties, which do create income for me, whatever those are, they should be creating income for me. This is what your standard personal financial statement asset side will look like. Average American is going to have some of this here, liquid assets, and then they're likely to have primary home and car, but not necessarily, I'm going to zero these out, not necessarily have business interests, not necessarily have rental properties, not necessarily have that which drives income. And remember how I said income producing assets rock? Look at what just happened to my income column when I removed these two very important things that I can invest in to drive more income. If I'm a standard individual and I am gunning to buy that primary home, put a lot of money into my car, and have some investment accounts and a little savings account, I am not driving the other piece of the equation, the other side of the equation, which is really driving that revenue from my assets. That's the shift in wealthy mindset. From standard mindset to wealthy mindset is, how do I bump up and put more into investment accounts, but moreover, how do I also expand and diversify the types of financial assets that generate more revenue for me? So how do I create a business that my accountant helps me value at $300,000? How do I purchase a rental property for myself that helps me create revenue? This is your leveling up, right? It's not just investment accounts that should be generating income. It's also thinking of other ways that you can invest in financial assets, businesses, properties, commercial real estate, properties, rental properties that can help throw off income. So rule number one, income producing assets rock. And you're going to see this when we flip over to the liability side. So the other thing I want you to take away, which is part and parcel of my rules. So rule number one is income producing assets rock. Rule number two is there's three major places that individuals make money from their assets, not from a job, their assets. And those places are, as I mentioned, investment accounts, your retirement savings accounts, your brokerage accounts, trust accounts, if you are setting those up. So you can make money in investment accounts. You can make money from business interests. You can make money from rental properties. Business interests can be limited partnership interests. You don't have to be in the driving seat. You just invested in somebody else's business or a syndication of somebody else's business. If you yourself are in the driver's seat, good for you. You're likely going to have the most ownership interest. Rental property, if you're the owner, fabulous. If you're an LP or a syndicate member of somebody else's rental property, but you're getting income from that, good for you too. So when you think of it this way, as you're making money, where are you putting your money? If you're putting your money that you're making into things that throw off more money, you are going to ultimately get to a place where your assets, the assets over here, cover the liabilities over there. The income from the assets cover the expenses for the liabilities. That's incredible. Incredible. So let me take off the business interest for a moment. Let's take off the rental properties. I'm going to flip over to the liability and net worth side. And we're going to talk a little bit about good debts and bad debts now. That's rule number 3. There are good debts, and then there are not so good debts. I don't want to say bad debts because that makes it sound like you're not paying. There's good debt, and then there's not so good debt. What's the difference? Well, not so good debt just costs you a lot of money. Move my head. You don't need my head right there. Not so good debt costs you a lot. The price per pound, the price of that debt is really high in comparison to the size of the debt. So when I look over here at credit cards and personal loans, you're going to be paying an arm and a leg, even though the size of these short-term debts, short-term just means that they're going to be, typically there's a due date that's monthly, that's rolling, that you have to keep making that statement balance. You have to keep paying it. You can't mess around. You've got to keep paying that down and chipping away, versus longer-term debts, which are supported typically by some asset. And so you have a longer term, to pay those assets down, and the interest rate that you're going to be charged typically is lower. So there is literally nothing wrong. I'm not about ready to say to anybody that, having credit cards is the worst thing you could ever do. Having personal loans is the worst thing you could ever do. There are debts that we have. We have a basket of debts, from the short-term debts to the long-term. And in the basket of debts are different types of debts. And they have their different pros and cons, every single one of those debts. So in the short-term debt category, personal loans I'll leave aside for a moment, but credit cards, there are people, myself included, who play the meanest points game with their credit cards you could ever imagine. Doesn't mean I carry a balance on my credit cards, but I do use them every single month, and I spend a lot so that I can get a ton of points, and then I pay it all off. That's how I use credit cards. So there's a pro if you're really systematized and very strategic about using credit cards. It doesn't mean credit cards are all bad. You got to be really diligent and really committed to making sure you don't slip up in the credit card category. But they're not all bad. They are high interest rate debts, which means they're not so good to carry around for the long term. I believe I marked this at 24% interest rate for the year. So even though it's only a $2,000 balance, I'm going to pay $480 in interest on that guy for that doesn't feel right. For $2,000, I'm paying almost 24% of it. I'm paying a quarter of it in interest on top of the $2,000 I borrowed if I don't pay it off. If I just make the minimum balance and then I have to pay the interest every month. So there's a time and place for credit cards, but it doesn't mean you should be going wild with your credit cards and just carrying them along with these, it's very expensive debt to have. Personal loans are also very expensive debts to have. I marked this at 12%, but there may be a reason you have it for a period of time. We don't judge. We don't laugh at you. We don't yell at you. We just say, there's better debt. There's better debt to carry. If you're going to, and wealthy individuals know this. Wealthy individuals know this. Primary mortgage debt, not such great debt to carry. It's not such great debt to carry, even though it's low interest rate. Why? Because your primary home doesn't throw off any income, right? So I want folks to remove the emotion of the primary home out of it. Take the emotion out. And from an intellect, from a logic point of view, carrying an 80% mortgage, let's say you just bought this home for $600,000, primary mortgage of $480,000, 80% LTV, loan to value. Carrying this for, I made 6% interest rate, 30-year term, $34,000, $35,000 a year of payments on this property. Okay, so you're not throwing off any cash over here, which means you have to work because you don't have any other assets that can cover this for you. You don't have financial assets that cover your expenses. This is just a net outflow. Your primary home is a net outflow for you. So what does that mean? That means you're beholden to having to continue to receive money from somewhere else other than your assets. Now, let me plug back in over here. I think I had $300,000 in business interests, and I had value of my business interest, and I had $200,000 in a rental property. And then I put a mortgage on each of these, or a loan with backed by the value of the business, backed by the value of the rental property. I've put a loan against each of these for 60% of the value. And so therefore there's going to be interest and principal expense that has to be paid for these business debts and the commercial mortgage against the rental property. But you can also see that these, presumably, the reason you've invested in these assets is because these assets are generating revenue. So these are not, air quotes, bad debts. These are supported by something that generates revenue. And so that's a really important thing to understand. When folks say all debt is bad, because there are a lot of people who say all debt is bad, they're completely ignoring how wealthy individuals truly operate. Wealthy individuals view debt as a tool in the toolbox that helps them to acquire things that create revenue. This is not for the faint of heart, and I'm not saying go out and get the highest debt you can to buy assets. That's not at all what I'm saying. What I'm saying is there's a time and a place to use that tool in your toolbox as you're working on building up your overall wealth. Furthermore, let's pretend these personal loans, this $10,000, here's an example of not bad debt. Let's pretend, or not so terrible debt. It's actually pretty good debt. If this personal loan here is actually backed and supported by your stocks and bonds, by your investment accounts, if you're able to, let me move my head here, if you're able to get a margin line of credit from your brokerage company. So you have a bunch of stocks and bonds, you don't want to sell them and use that cash because then you have to pay capital gains tax. And you want to continue to reap the benefit of having these investment accounts. If your brokerage company is willing to give you a loan, a margin line against these investment accounts, you never have to unwind these positions, and you can take as you need money you're borrowing against your positions, which are presumably growing, and presumably you're making more in income against the interest you have to pay over here. That's actually a really smart deal. And again, it's a tool in the toolbox that the wealthy use all the time. They don't unwind their brokerage positions. They don't sell their stocks and bonds. They borrow against them in order to create liquidity for themselves for the next investment. Why am I showing it to you all this way? Why am I showing you the expense and the income, and here's how I would lay it out? Because I love to be able to clearly see for myself. And this is not my balance sheet. As inside, this is not my balance sheet. My balance sheet looks different. But I want to be able to see that I am generating income against these assets. The value of my assets is greater than my long-term debts. I can cover the expenses with the income on my assets, coming off of my assets. So I have now created for myself financial freedom because my assets cover my expenses. In business financial statements, you will find there will be three financial statements that you'll typically see when folks, accountants or others, personal financial planners, when they create business statements. Sorry, I said personal financial planner. I didn't mean to say that. Accountants who are working on business statements. So if the CFO or the accountant or the controller is looking at creating the statements for the business, they're going to create three statements. They're going to create a balance sheet. They're going to create an income statement, which shows the money coming in and out of the business. And then they're going to create something called the statement of cash flows. And the statement of cash flows is what helps tie together the balance sheet and the income statement. You can do personal financial statements similar to that, but I'm effectively shortcutting it with a really simplified view. Because in personal finance, we don't use accrual typically, so we don't like carry over things like businesses do. We have an asset that's current and you're waiting for payments to come in. We don't typically recognize that. We typically treat ourselves individually as cash in, cash basis, cash in and cash out, as opposed to I'm waiting for payments. Just a different mindset. So the reason that I choose to look at balance sheets this way is in the teaching of balance sheets. This helps the average person who's never thought of it this way, who's not gone through a full accounting class or a full finance class. This helps everyone to say, oh, I get it. This is why lifestyle creep, buying a bigger and bigger primary home but not paying attention to buying other assets that create real revenue, this hole here with a corresponding large expense is the reason that lifestyle creep can really hurt you. Because if anything happens to your job, which is your income source, and you don't have any of these other income sources, you have a financial moment of peril for yourself that you have to sort, and you will sort because you're strong. And no one should feel bad if they don't have a balance sheet that looks like this. That's okay too. We all have to open-mindedly look at these things and then say, what are my takeaways? So I want you to take away from this 3 rules, 3 things that help you become wealthy. One is income-producing assets rock. All of these line items that throw off real income, they rock. Knock that right in because that is so important. Number 2, that there's really 3 major places to make money. And those 3 places to make money are your investment vehicles, your investment accounts, your business interests, and your rental property. There are more, but I'm trying to keep this as straightforward as possible. So number 2, 3 major places to make a lot of money on your balance sheet in the assets that you invest in, that you own, that you have equity in. And then number 3 is there are good debts, the stuff down here that costs you a lot less than the stuff up here. And there are not so good debts like your credit cards. We don't beat ourselves up. There's a time and place to use credit cards. As you get more and more sophisticated, you realize that there are places where each of these debts come in handy, but you treat them like tools in your toolbox as opposed to debt is bad, totally don't even touch it ever. No, you learn how to work with it instead of being fearful of it and never putting it in your toolbox. I hope that this was so helpful to you. I love talking about this stuff. I have my mini course live on legacy.com. To everyone who absolutely hates everything I just did, please feel free to leave me comments and tell me how terrible it is. I'm going to wish you the best of luck and so much love because I love you, even though maybe you don't really like yourself that much. I hope it gets better, truly. So please, please feel free to check me out. This is really something I love to talk about, and I hope it was interesting the way that I described it to you. But feel free to give me feedback about how terrible it was if you really didn't like it. Have a wonderful day. Bye-bye.